Why do some investors build lasting wealth while others constantly rotate, react, and reset? The difference often comes down to one shift in perspective. They stop thinking like traders. They start thinking like owners. Owners don't obsess over daily price movements. They focus on durability, cash flow, competitive position, and long-term value creation. The monopoly strategy is rooted in that mindset. It's not about chasing headlines. It's not about predicting short-term macro shifts. See, it's about owning dominant businesses that can compound capital over time. Let's break down what it truly means to invest like a business owner, and how that philosophy shapes the approach behind the Monopoly ETF ticker, MPLY. Thinking like an owner. When you buy a share of stock, you are not renting a ticker symbol. You are purchasing a fractional ownership stake in a real business. That distinction matters. If you owned a private company outright, you wouldn't check its valuation every hour. You would ask, is revenue growing? Are margins stable or expanding? Do customers remain loyal? Is management allocating capital wisely? Does the company hold a durable competitive advantage? Public markets often obscure this mindset. Price volatility can dominate attention. Short-term narratives can overshadow long-term fundamentals. But business owners focus on economic reality, not daily quotations. They care about cash flow generation, return on invested capital, reinvestment opportunities, competitive positioning, industry structure. This is the foundation of the monopoly strategy. It begins with a simple question. If I were buying this entire company outright, would I want to own it for the next decade? Ownership changes. Behavior. When you think like an owner, 3 behavioral shifts occur. First, you become more selective. Owners do not acquire businesses casually. They perform due diligence. They assess competitive threats. They evaluate balance sheets. Second, you become more patient. Building a durable business takes years. Compounding takes time. Owners understand that volatility does not equal deterioration. Third, you prioritize quality over quantity. Owning 100 small stakes in average businesses is different from owning meaningful stakes in structurally advantaged ones. The monopoly strategy emphasizes concentrated discipline, not reckless concentration, but intentional exposure to companies with enduring economic power. Owning dominant platforms. Not all businesses are created equal. Some compete, some survive, some dominate. Dominant businesses share common characteristics: significant market share, strong brand equity, high switching costs, network effects, cost advantages, regulatory or structural barriers. These advantages form economic moats, a concept popularized by Warren Buffett. A moat protects profitability from competition, and it allows a company to sustain high returns on capital over time. In modern markets, dominance often manifests through platforms, digital ecosystems, payment networks, software infrastructure. Consumer brands are embedded in daily life. Platforms benefit from scale. As more users join, the product becomes more valuable. As scale increases, costs decline. As data accumulates, advantages compound. This creates a reinforcing loop. Smaller competitors struggle to match investment budgets, distribution networks, and brand recognition. Leaders widen the gap. Owners recognize this dynamic. They don't just look for companies that are profitable today, they look for companies positioned to control their industries tomorrow. Pricing power. The owner's advantage. One of the clearest signs of dominance is pricing power. Pricing power is the ability to raise prices without losing customers. For a business owner, this is critical. In inflationary environments, costs rise. Without pricing power, margins compress. With pricing power, profitability holds. Dominant platforms often possess this flexibility because customers rely on them. They are embedded in workflows. They are integrated into ecosystems. They are trusted brands. This stability protects cash flow. And stable cash flow funds, research and development, strategic acquisitions, share repurchases, balance sheet strength. Owners understand that pricing power is not about short-term gains, and it is about long-term resilience, the long-term mindset. Perhaps the most defining feature of the monopoly strategy is the time horizon. Short-term traders seek price movement. Owners seek value creation. Value creation unfolds over years, not quarters. Companies with durable competitive advantages often compound steadily. Revenue grows, margins expand, cash flow increases. Capital is reinvested at high returns. This compounding effect accelerates over time. The first 5 years may look modest. The next 10 can look exponential. But this requires patience. A long-term mindset also reduces emotional decision-making. Volatility becomes noise. Temporary setbacks become opportunities to reassess fundamentals, not reasons to panic. The monopoly strategy is built around this long-term orientation. It assumes that structural strength compounds. It prioritizes durability over excitement. Why concentration reflects conviction. Broad indexing has clear advantages. Low cost, broad exposure, high simplicity. But owning 500 companies through the S&P 500 means owning everything. Leaders, laggards, innovators, and businesses facing structural decline. That is exposure. It is not selectivity. The monopoly strategy asks a different question. What if we intentionally concentrated on companies exhibiting monopolistic characteristics? Dominant share, durable moats, structural advantages. Not literal monopolies in the regulatory sense, but businesses that control meaningful portions of their markets. Concentration in this context reflects conviction. It says, these companies have earned weight because their economics justify it. This is not about speculative bets. It is about disciplined prioritization, highlighting the MPLY philosophy. The Monopoly ETF embodies this ownership mindset. Its philosophy centers on identifying and holding companies that demonstrate dominant market positions, durable competitive moats, consistent profitability, pricing power, structural industry advantages. Rather than replicating the entire market, MPLY narrows its focus. It seeks exposure to businesses that operate with monopolistic characteristics. The idea is not to chase trends. It is to align capital with structural strength. This approach reflects 3 core principles. 1. Think like an owner. Evaluate businesses based on economics, not headlines. 2. Own dominant platforms. Prioritize scale, network effects, and sustainable competitive advantages. 3. Maintain a long-term horizon. Allow compounding to work without constant interruption. This is a concentrated discipline packaged in an ETF structure. It systematizes what many long-term investors attempt to do individually. Discipline over activity. Owners do not transact constantly. They operate strategically. The frequent trading introduces friction, taxes, fees, and emotional errors. The monopoly strategy favors stability. It seeks businesses capable of enduring through cycles, recessions, inflation spikes, technological disruption. Dominant companies often have more tools available during stress. Strong balance sheets, brand loyalty, cash reserves, operational flexibility. This resilience supports long-term compounding. The psychological advantage. There is also a behavioral benefit to investing like an owner. When you understand why a company dominates, why customers stay, why margins hold, why cash flow grows, volatility feels less threatening. Confidence supports discipline. Discipline supports compounding. Interrupting compounding is one of the most common investor mistakes. Owners stay invested. They reassess fundamentals, but they do not react to noise. The monopoly strategy aligns with this temperament. Here it favors structural advantages over short-term narratives. Risks and reality. No strategy eliminates risk. Dominant companies can face disruption. Regulation can alter industry dynamics. Leadership can falter. Ownership does not mean blind loyalty. It means continuous evaluation of the competitive position. The monopoly strategy acknowledges risk, but it prioritizes businesses with structural defenses. It aims to tilt the probability in favor of durability. A framework for serious investors. An investing like a business owner requires clarity. Clarity about what you own. Why do you own it? How it generates value. What could threaten it? It requires resisting the urge to chase momentum or headlines. It requires accepting that real wealth is built gradually. The monopoly strategy is not about excitement. It is about endurance. It is not about predicting the next quarter. It is about positioning for the next decade. Final thoughts. Thinking like an owner changes everything. And it shifts focus from price to performance, from volatility to value, from quantity to quality. Owning dominant platforms with durable moats allows capital to compound alongside businesses that control their industries. A long-term mindset allows compounding to unfold without interruption. The Monopoly ETF reflects this philosophy. It concentrates on companies exhibiting structural dominance. It systematizes ownership discipline. It aligns with a simple but powerful thesis. Dominance compounds. New for investors who believe durable competitive advantages drive long-term returns, the monopoly strategy offers a structured way to invest like a business owner, without managing individual positions manually. If you found this breakdown helpful, follow for more deep dives into disciplined investment strategies. No hype, no speculation, just clear thinking. Drop a comment below. Do you invest like a trader or like an owner? And if you're curious about MPLY, review its methodology. Understand how it screens for dominance, and always read the prospectus before investing. Long-term wealth isn't built overnight. It's built by owning the right businesses and giving them time to work.